Adjusting journal entries. Adjusting journal entries are made in the general journal and is the fourth step of accounting. It is necessary as the exchange of cash does not always coincide with the provision of goods or services. There are four basic scenarios in which this may occur. Businesses may receive cash before the provision of their product, or when expenses are paid prior to its use. When recorded in accounting records, this method is known as the cash basis and derives directly from the matching principle. In contrast, businesses may provide a service before they are paid for it, or an expense can be incurred by the business, which they have not paid for. When recorded in the accounting records, this method is known as the accrual basis of accounting and derives directly from the revenue recognition principle. When cash is received before the revenue is earned, it is known as a deferred revenue. Consider the purchase of an airline ticket. Cash is received by the business, but they are left with the obligation to provide services. In the initial journal entry, note that this is not the adjustment. We debit cash for $1,000 and credit unearned services revenue for an equal amount. When adjusting this entry, we debit the unearned service revenue to show that the obligation has been met and credit service revenue to show the revenue has now been earned. Generally, we debit a liability and credit a revenue. When a service has been provided prior to the exchange of cash, we have an accrued revenue. Suppose a photographer is hired at a film festival and is paid in the next month. Since the service is provided prior to receiving cash, there is only an adjusted journal entry, where we debit accounts receivable for $3,000 and credit service revenue for an equal amount. Generally, we debit an asset and credit revenue. When businesses pay for a resource in advance, they have a deferred expense. Prepaid rent is a common example, where there is an initial journal entry debiting prepaid rent for $1,200 and crediting cash for $1,200. Depending on the period, adjustments can be expressed as an expense for a proportion of the total income. If the period is 1 month, it will appear as a debit for rent expense of $100 and credit prepaid rent $100, as 1 month's worth of the asset is used. For the year, it would simply be $1,200. Generally, we debit an expense and credit a prepaid asset. When businesses use a resource before paying for it, it is known as an accrued expense. Electricity bills is a common accrued expense, and the adjustment would appear as debit electricity expense and credit electricity payable. Generally, we debit an expense and credit an account payable. Key rules when adjusting journal entries is that temporary accounts must be reset by the end of the period, and cash is never adjusted because it is only exchanged in initial and ending journal entries.